Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for July 2017. Well, tanker rates continued to decline during June. In fact, in June we had the lowest tanker rates in 10 months since August of last year. And for the month of June itself, it was the lowest in 4 years. So we really are coming now to the bottom of this current cycle in the tanker market, a cycle which started 4 years ago in late 2013, reached a peak at the end of 2015, and now we're coming back down into the low point of the cycle again. And the main culprit for the low rates this time around, especially in the last few months, has really been fleet growth. If you look at the size of the tanker fleet now compared to the size of the fleet a year ago, the VLCC fleet is about 7.5% higher, the Suezmax fleet's about 8% higher, and the Aframax fleet's about 5.5% higher. So that's a lot of ships for the market to absorb at a time when demand is growing but is not growing that strongly. And the reason why demand hasn't been growing that strongly is primarily because of the OPEC supply cuts, predominantly out of the Middle East, which has cut some tanker demand from that region. Now that has been offset by some longer haul movements from the Atlantic to the Pacific, as we've pointed out in recent weeks. We've seen higher production out of the United States, higher production out of places like Libya and Nigeria, and that has offset some of the Middle East cuts, but it hasn't been enough to create strong tanker demand growth. So whereas tanker demand has been growing at maybe 2 or 3%, the fleet, as I've just said, has been growing at much higher rates than that, and that's really been putting pressure on tanker demand. As we look ahead to the rest of the year, I think one of the main themes that is emerging is that the rebalancing of oil markets, which was expected to take place over the next 6 months, may take a little bit longer than was previously anticipated. And that's because OPEC have been maintaining their cuts, but US production has probably been a little bit stronger than was previously expected. And we've also seen a strong comeback from those OPEC countries which are not part of the cuts, so namely Nigeria and Libya. In fact, this month Libya looks like it's got back to about 1 million barrels a day of production, which is the highest in 4 years. And Nigeria is getting back to about 2 million barrels a day of production. So that's offsetting the OPEC supply cuts and is keeping oil prices low. And will probably mean that rebalancing, like I said, won't take 6 months. It may take 9 months or a little bit longer. And that has some positive impacts, but it has some negative impacts as well. On the positive side, more exports out of Libya and Nigeria is going to be positive for mid-sized tanker demand. And also it will keep pressure on oil prices, which is good for bunkers, and it's good for oil demand as well. On the negative side, the longer it takes for the oil markets to rebalance, the longer it will take for OPEC to open the taps up again. And in fact, OPEC's meeting next month with some of its non-OPEC partners as well, and possibly even Libya and Nigeria. And they may look to bring Libya or Nigeria into the cut agreement, or they may look to steepen the cuts compared to where they already are, in which case that would again be negative for tanker demand through the next few months. So what does that mean for rates and where we are in the cycle? Well, for Q3, that's traditionally the weakest part of the year for tanker rates, and we think that the weak rates that we're currently seeing in June will continue through to Q3, probably exacerbated a little bit by the fact that Saudi usually keeps a bit of oil at home during Q3 for power generation, and also China looks like it's going to have quite a bit of refinery maintenance coming up. Could be taking about 10% of their refining capacity offline during Q3. So we do think that rates will stay very weak through Q3 and that the winter will be quite muted compared to the past 1 or 2 years. But we still maintain our outlook that the tanker market will turn in 2018, more likely in the second half of the year, as that tanker fleet growth, which as I say has been pretty high this year, should come down to about 3% next year and only about 2% the year after, despite the fact that we've had some tanker orders in the early part of the year. So as that fleet growth comes down and as OPEC starts to increase supply again once the markets have rebalanced, then we do expect that the tanker market will show recovery starting second half of next year and strengthening into 2019. So that's our update on the conventional tanker market, and we'll speak to you again next month.